You wouldn't use the same car for a quick city commute and a huge cross-country road trip, right? Well, the same goes for your investments. The tools you use need to change as your life's journey unfolds. So today, we're laying out the ETF roadmap, a strategic guide to help you build a portfolio that is perfectly tuned to whatever stage of life you're in. Let's get into it.
Here's a quick look at our route. First, we'll get to know our vehicle, the ETF. Then we'll look at the master plan, what we call your lifestyle strategy. From there, we'll dive into the 3 main acts of your financial life. And finally, we'll cover exactly how you can put all this into practice. Okay, so first things first. Before we can even think about navigating the road ahead, we've got to get familiar with the engine of our portfolio, the exchange-traded fund, or as you'll hear me say a lot, the ETF. Now, the best way to think about an ETF is to picture a shopping basket. Instead of going down the aisle and buying just one single item, like one stock, an ETF lets you buy the entire basket at once. And this basket is already filled with dozens, sometimes hundreds of different assets. Right away, this gives you instant diversification. Plus, you know exactly what's in the basket, and you can buy or sell it all day long, just like a regular stock. This is really where ETFs just blow the old way of doing things out of the water. I mean, compared to mutual funds, ETFs are just built for today's investor. They trade all day, not just once at the end of the day. They're also structured to be way more tax efficient. And maybe most importantly, they are significantly cheaper. You see this number here, the expense ratio? That's just the annual fee. For ETFs, that fee is tiny, like 0.05% on average, while many mutual funds are charging 0.22% or more. And that difference means more of your money stays in your pocket, working for you.
And just to show you how big a deal that tax efficiency is, get this, an incredible 82% of Vanguard's ETFs paid out zero, that's right, zero, taxable capital gains over the last 5 years. That is a massive advantage that so many people overlook, and it directly pumps up your net returns. It's one of the main reasons pros lean on this tool so heavily.
Look, to make smart choices, you really only need to understand these 3 key things. First, is the ETF passive, just mirroring an index like the S&P 500? Or is it active, with a pilot trying to beat the market? Second, what's the price tag? That's that super low expense ratio we just talked about. And finally, how does it handle risk? Well, usually it's through that awesome diversification we mentioned, spreading your money across tons of different companies and sectors.
Okay, now we're getting to the heart of the strategy. If you take away one thing, let it be this. Your portfolio is not set in stone. It's a living, breathing thing that has to evolve with you. The formula is actually pretty simple. How much risk you can stomach, plus how much time you have, equals how your portfolio should be built.
And this chart just illustrates that idea perfectly. Take a look. When you're young, your portfolio is all about that green area. Equities, growth. You've got decades ahead of you, so you can take on more risk for potentially higher returns. But as you get older, notice how that green line starts to slope down. And at the same time, the blue and red areas, that's fixed income and cash, start to rise up to protect the wealth you've built. This is basically your financial life on a single chart.
So yeah, the takeaway here is absolutely crucial. The best portfolios are dynamic. They adapt, they shift, and they mature right alongside you.
All right, let's jump into Act 1, the young investor. We call this the accumulation phase, and believe me, the name of the game here is aggressive growth. The strategy at this stage is really straightforward. Time is your single greatest asset. It's not even close. You literally have decades to let your money compound and to bounce back from any market slumps. And that superpower lets you embrace a little more volatility in areas like tech or small companies, because that's where the highest potential for long-term returns is.
So this watch list totally reflects that growth-first strategy. You're seeing ETFs that are all about innovation, things like the NASDAQ 100, pure technology funds, and the small-cap Russell 2000 index. These are the powerful engines of a portfolio that's in that accumulation phase.
Now for Act 2, the mid-career investor. Here, the focus totally shifts. It's not just about pure growth anymore. It's about consolidation. You're trying to balance that growth with a little more stability.
So during these peak earning years, your approach changes. You're likely making your biggest contributions ever, so you really want to start protecting what you've already built. The goal is to dial back some of the risk by shifting toward more stable, blue-chip companies and to start thinking about hedging against inflation. You're basically building a sturdy bridge to a secure retirement.
And you can see that pivot right here in this watch list. We're seeing industrial giants in the Dow Jones, you've got exposure to the financial sector, and you have established international markets. We also start to see a bit of portfolio insurance, like gold, which can help guard against bumps in the road and inflation.
And that brings us to our final act, the retiree. In this preservation phase, we pretty much flip the playbook on its head. The primary goal now is all about defense.
The logic here is 100% about preserving your capital and generating income. You have to protect that nest egg from a market crash, especially right when you start withdrawing money. That's a huge risk. So your portfolio gets a new job. Its job is to create a reliable cash flow, almost like a paycheck, to replace your salary. And that means you focus on stable, defensive companies that do well no matter what the economy is doing.
This watch list is built for exactly that: income and safety. You've got consumer staples, companies that sell things we all need, no matter what. You've got healthcare, which always has steady demand. And then you have the income generators, like real estate and, of course, a big slice of fixed income bond ETFs to provide that steady, reliable paycheck. So, we've covered the what and the why. Now let's get down to the how. Let's turn all this theory into some simple, practical steps you can actually take.
It really just boils down to these 3 steps. 1. The vessel. Open a brokerage account. It's super easy these days. 2. The filter. Use the free screening tools on their website to find ETFs that match your goals. Remember to look for those super low expense ratios. And 3. The order. Just type in the ticker symbol and place your trade. That's it. Remember, time in the market is what counts, not trying to time the market.
This quote just says it all, doesn't it? It's so easy to feel like you've missed the boat, but the single most important thing you can do for your financial future is to simply get started. Being consistent is so much more powerful than trying to be perfect. So, what are the big takeaways from our roadmap today? First, cost. ETFs let you keep more of your hard-earned money. Second, access. You can literally own a diversified piece of the entire global economy from a single account. And most importantly, flexibility. You can easily adjust your strategy to match your stage in life. This isn't a one-and-done plan. It's a living roadmap.
Look, it really doesn't matter if you're 18 or 60. There is a lane on this road for you. The only wrong turn you can make is staying parked on the sidelines, letting inflation eat away at your savings. So the real question isn't whether you should start, it's where will your roadmap take you?